The ultimate guide to interest-only mortgages, let's go. Now, word of warning, we are going to have a lot of fun in this video, but we're also going to get really nerdy. Now, we're going to start with the basics, then get to the more advanced stuff. But what that means is whether you're just starting out or whether you are an old hand at this sort of stuff, you're going to have something to take away. It's going to be a lot of fun. Now, let's start by comparing interest-only and principal and interest mortgages. What's the difference? Well, on interest-only, when you make a payment each week to the bank, what are you doing? Well, you're only paying the interest on the mortgage, for instance, 4%. With P&I, or principal and interest, yep, you're going to pay the interest or the cost of borrowing to the bank, but you're also going to pay back some of the original loan, the principal, in each payment you make. Now, what does that mean? If you go interest only, you tend to have lower payments. If you go principal and interest, you're going to have higher repayments, or at least in the short term. So let's look at the pros and the cons of both IO and P&I. Well, for interest only, major pro, and the reason a lot of investors go for IO is cash flow. Let me give you an example. Let's say you take out a $650K mortgage at 4% interest. What would your repayments be? Well, if you're on interest only, it's going to be $500 per week. If you're on P&I, it's going to be $716 per week, over $200 more. Now, let's apply that to a cash flow model. So this is the real annual cash flow of a property that we'd recommended to some investors here at Opus Partners. Well, in both instances, you see the property starts out as negatively geared. But if you were on interest only, under these projections, it would start to go positively geared. Now, in interest only, you'd end up putting in just shy of $72K into that property to top it up. But with P&I, principal and interest, you'd be putting in $225K of cash. That's $150K more if you were on principal and interest. So the big pro of interest only is cash flow, but what's the con? You end up paying more interest over time. Let's start to get nerdy and look at some graphs. So if you go interest only, the size of your loan never goes down because you're not paying any of it back. Now, what that means is your interest repayments will be the same each year. So the total amount of interest you pay goes up in a straight line. Now, if I compare that to principal and interest, what happens to your loan? Well, it goes down because you're slowly paying it off. And if the size of your loan is decreasing, well, what happens? You start to pay less interest because the size of your loan has gone down. Now, what's important to note is, of course, you still have to pay down that debt. We still need to take into account those principal repayments you're making. So when we compare them, if you go principal and interest, your total repayments will be higher. If you go interest only, your total repayments will be smaller. But the amount of interest you will pay on principal and interest is lower. You're going to pay more interest in total if you go interest only because, of course, your debt goes down on P&I. It stays the same. It doesn't go down on interest only. So let's again just go through these pros and cons. Interest only, really good cash flow, but you're going to pay more interest over time. P&I, well, great thing, you're going to be reducing your debt, but you're also going to pay less interest. What's the flip side? What's the con? You're going to have those higher repayments earlier. You're going to have worse cash flow. Now, usually at this time, when I'm out talking to property investors at the local Property Investors Association right around New Zealand, somebody will put up their hands at this point and say, well, how likely is it that I'm really going to get an interest-only loan? Because the anecdotal feedback at the moment, especially for older investors, is that the bank really wants older investors to start paying down their principal, especially if they're getting close to retirement. Well, let's look at the data. And here I've got some data from the Reserve Bank of New Zealand, which shows the percentage of new investor loans which are being taken out on interest only. And what do we see? 41% of investors taking out a new mortgage are taking it out on interest only. Now, that doesn't mean that you've only got a 4 in 10 shot of getting approved because not every investor will have applied for interest only, but it does give you a sense that at least 2 in 5 investors out there are taking out new mortgages on IO. This gives you an indication, but look, from our experience, if you ask for it in the right way, if you apply in the right way, you do have a good chance of getting that interest-only mortgage application approved. And in fact, the vast bulk of our investors here at Opus Partners decide to go on interest-only, and I'll tell you the reasons why shortly. Now, at this point, you're probably wondering, well, how long can I get an interest-only loan for? Because it is important to note that most major banks are only going to approve you for 5 years on interest only. So let me show you how that tends to work, and we'll talk a little bit about non-banks later. When you take out a mortgage, whether it's interest only or P&I, they are going to give you a maximum of 30 years to pay that off. Now, the way it's structured with interest only is they'll approve you for that 5-year interest only period, but then they'll tag on and say, well, you need to pay back the mortgage, you need to pay back the loan in 25 years once that's over. So the way that a bank assesses whether you could afford an interest only loan is they will say, can you pay the whole loan back at our higher test interest rate, 6.7% in this example, and over the shorter period, 25 years. So let's say you've applied for a $650K loan. If you did it over a 30-year P&I period, i.e. you're going to go on principal and interest, you'd need to show them that you could afford a loan of about $4,200 per month. That would be the repayment you'd have to afford. Higher interest rate, P&I 30 years. Well, if you applied for interest only though, it'd be higher because same interest rate, but they're assessing you over 25 years, even though while you're on interest only, you're going to be paying back a smaller amount. So they need to see that you can afford $276 more, almost $4,500 per month. So the key takeaway there is you often need more income to afford an interest-only loan in order to be approved for that interest-only loan. Now I know what you're thinking. Well, I get my 5-year interest-only period. I hold the property for 5 years. What happens at the end of that? Well, there are two main things that can happen. Either you can revert back to principal and interest. So you go through your 5-year interest-only period, you're now on principal and interest, and you're paying it back over a 25-year period. That means that your repayment will be higher. It'll actually be higher than if you were paying it back over 30 years. What's the other thing that you could do? Well, this is what we see most common. We see a lot of investors apply for another interest-only period. And that happens very, very frequently. Let me show you how that works. So you've gone through your first 5 years and now you've got a 25-year principal and interest mortgage. Well, you can apply for another 5-year period. But what's going to happen? Well, they're going to assess it on the remaining time. The bank's going to see whether you could afford to pay back that loan over 20 years now. So your 25-year mortgage minus your 5 years interest only. Now that means that they need to assess whether you could afford the even higher repayment, over $4,900 in this example. That is why it can often get harder to keep getting interest only approved with the same bank. So what can you do in that scenario? Either you could apply to extend the term. So rather than saying, okay, I'm left with a 25-year term, why don't I kick the term back out to 30 years and apply for a 5-year interest-only period again? That's one option. The second thing you could do is refinance to another bank. So let's say you're with your bank and it starts with an A and they say no, they're not going to approve you for another interest-only period. Well, you can always apply to a different bank, maybe one that starts with a W or a B, and maybe they'll approve that. In that case, if they've got the right product that you want, you can move to them. And in fact, we've seen investors do this for years and remain on interest only for 10 years, 15 years, sometimes even more. The third thing you can do is apply for a non-bank lender because some lenders out there have specific products for investors. So I want to start by talking to you about Resimac. So they've got a 20-year interest-only product. Now, there are some specifics about this, like the max is 50% LVR that you can borrow. But that does mean that you can lock in the fact that you've got interest-only payments on this specific mortgage for up to 20 years. So that's something to talk to your mortgage advisor about to see whether that could be a good fit for you. Now, ultimately, interest-only loans, they aren't the right fit for everyone, and not everybody should go on them forever. But who would it be the right fit for? Who are they not so much the right fit for? Well, you know what? Switching to principal and interest often can be the right decision, especially for older Kiwis, especially if you've already got rid of your personal mortgage. So if you've got rid of your personal mortgage, you own your own home freehold, and you've got a couple of investment properties, could be a good time to start paying down debt. But you know what? If you're a younger investor, you've got a personal mortgage, what we generally see investors do is go interest only on their investment properties, and then any money that they would put into those investment properties to pay down debt, they focus on just smashing down their personal mortgage first. That's generally what we tend to see. But ultimately, what's right for you? you've got to need to talk to your mortgage advisor, you've got to need to assess your personal situation. Now, what I want to know is, what's your strategy? Do you like interest only, or do you prefer principal and interest? Let me know in the comment section down below. And look, while you're there, hit the subscribe button, smash that little bell so you get notified about all our future videos.